Take a moment, look at the disclaimer. The contents for educational, information, entertainment purposes only, and nothing should be taken as a recommendation to buy, sell, hold any securities at any time. We're here just to tell you how we analyze the markets, how we look at the market. This is Rod from BTA, and we are known as the middle traders. We are not going to get in at the exact bottom, and we are not going to get out at the exact top, but we will. We are going to make money. Ching, ching, and lots of it in the middle. This is part 2 of our walking with the market. Okay? Like I said, we want to walk with the market. We want to stay in step with the market. We want to stay in tune with the market because we could get the market direction right. If we could get the market direction right, we're going to be right on almost everything that we do. Did you hear me? If we can get the market direction right, we are going to be right on almost everything that we do. Our teacher, the guru, the oracle, all right, of trading, William J. O'Neill, the man who taught us, said that the M in his trading strategy, the letter M, which stands for market direction, should have been first. If he could find a way to come up with a good acronym or something where he could put the M first, he would have done it because M equals market direction. And he said if you could get that right, you're going to be right on almost everything that you do. And I'm here to tell you right now, the man is right. Okay? If you right on that, you can almost buy the whole doggone list of the general market because it's going to go with the major market indexes. All right. This is a daily chart of the Dow Jones Industrial Average. And we got our guppy here. This is part 2 of walking with the market. The guppy is going to help us stay in the direction of the trend. All right. If we're trading or sit our behinds on the sideline, if things are not right, like right now. Right now, we in cash sitting on the sideline waiting for the next opportunity. It was already right here. Bingo. Short opportunity was right here. Now, can't chase it. Got to wait on the sideline, wait for the next high probability opportunity. Well, here's the guppy for the Dow Jones Industrial Average. As you can see, the magenta line of closing prices are below all of the shorter term, faster moving average, and they're expanding to the downside. The longer term key moving averages are also pointing down, and they're expanding to the downside. So the guppy for the Dow Jones is telling you that everything is down, down, down. It's going down. Okay? Now, let's look at the Standard & Poor's 500, the guppy for the Standard & Poor's 500. Let's move it up. Let's move this thing over a little bit so we can see it. Okay, let's move this thing over a little bit so we can see it. Let's try to expand this just a little bit. All right. So here's the guppy for the Standard & Poor's 500, the actual index itself. We just looked at the Dow Jones index, right? Now we're looking at the Standard & Poor's 500, daily chart of the Standard & Poor's 500 guppy. And as you can see, the magenta line of closing prices are below the faster, shorter term green moving average, and they're below the longer term faster, longer term slower red moving averages. Okay, the green moving averages are faster moving averages. The red moving averages up here are the longer term slower moving averages. The guppy, the magenta line of guppy prices, the magenta line of closing prices, the magenta line of closing prices. My goodness, I got a tongue twister. It's below all of the key moving averages, short term and long term, and everything is pointing down. Everything is expanding to the downside. It's going down. Okay, point blank and period. Now, let's look at the Nasdaq Composite. Okay, the Nasdaq Composite. Let's look at the guppy for the Nasdaq Composite. All right, and let's zoom in. Make sure you can see it. You see the magenta line of closing prices? You see the magenta line of closing prices is stuck below all of the shorter term, faster moving average. They have expanded. Okay. And you see the longer term, slower moving averages in red up top is also pointing down, and they have started expanding. Okay. And they all pointing to the downside. The magenta line of closing price got caught up in the turbulence of all the longer term moving averages, and it fell apart. Remember the short ching ching week and a half ago? There it is. Oops, there it is. Oops, there it is. It's going to be something interesting about that word oops. All right? There's going to be something interesting about that, hopefully, in the next couple of weeks. Remember that word oops. Oops. Remember that. Something interesting might happen with that word soon. Okay. Let's look at the weekly Fibonacci levels. Okay. The weekly Fibonacci. All right. This is our weekly Fibonacci chart. Now we're on the weekly chart of the Dow Jones Industrial Average with the Fibonacci on there, the retracement levels. Here was the low. We had the Corona collapse. This is the March 2020 high. Do you see that red line? Do you see that thick red line sitting right there? Do you see it? Can you see that thick red line? It's the March 2020 highs right here. Okay, we had that Corona collapse. We traded all the way down. This was the low of the Corona collapse. So you put the fib from the lows to the high, to the all-time high back over here in November. Well, right now we have traded back and almost back to the, well, let's stick with the fib for that now. We at the 38.2% level. We have given back, traded back 32% of the move. Okay, we are right now back to the 38.2% level. I'm sorry, 38.2% level right here. This little line right here might be hard to see. It's like a gold colored line right here, right above the red thick line. That is the 38.2% retracement level. That's where we at now. We hit that and we stalled. But not only did we hit that level, we also hit the red, thick red line. You see that big, thick red line there? We also hit that one, which is the high of the 2020 highs, the Corona collapse, the highs right before the Corona collapse. So the Dow Jones traded right to that level and held. And also what's interesting to hear, you see that little gold line right there? It might be hard to see that little gold line right above that thick red line. That's the 38.2 retracement level on the Fibonacci. Very strong support level. Very strong support level. A lot of machines, a lot of algorithms, a lot of traders watch that level, okay, on these fibs. So we got to watch it because the computers are programmed to watch it. All right, so we got to watch them. The 38.2 retracement level is where we found support at right now. And if you can see right here, a couple of times we consolidated right around that level. You see that? Came back to it, tested it, and then it broke out. Well, we right back to it now. If we break below that and break below this March 2020 high, that big, thick red line there, then the next level might be the 50% retracement level, which is right here, which is at 27,582. Okay, 27,582. That's the 50% retracement level. We come back down, I would look for that next level to possibly be hit for the Dow Jones, 50%. So that means that we would have retraced 50% of this move from the lows back in 2020 to the highs, all right, of last year, November 2021. That means we have came back. We would have gained back and gave back 50% of the move. Well, remember that level, right? The 50% retracement level. When we had our classes at browntradingacademy.com, we meet every Monday and Thursday. We've talked about the 50% retracement level that can make you rich. The 50% retracement level that can make you rich. All right? Stocks will pull right back to that 50% retracement level. If it start breaking below that, maybe to go to the golden pocket. Well, we'll talk about that in a few minutes. So the Dow Jones is right back to is at now that 28% retracement level, and it's touching and it's found support for right now. Found support at the highs of March 2020. Now let's look at the Standard & Poor's 500. Okay, this is a weekly chart. I'm sorry, this is the weekly chart of the Standard & Poor's 500 with our Fibonacci retracement levels on it. Same thing. We went from the 2020 lows to the highs of November. Okay, and you see, right now we have the Standard & Poor's 500 has broken below the 38.2% retracement level. The Dow Jones found support at it, and it found support at the March 2020 highs, but the Standard & Poor's 500 has broken below that level. We have now broken below. This week we broke below. Okay, we broke below it. All right, and now we may come down and test this 50% retracement level. This thick crayon line right here is the 50% retracement level. It's a possibility that we could come back down and test that. Okay, and where's that at? 3,500. 3,500 is where that is at for the Standard & Poor's 500. 50% retracement level is around 3,504. The 3,500 level. Look at part 2. Look at part 2. What did we say about trading down to these levels? Look at part 2. We start breaking through support. Look at part 1. I'm sorry. Keep saying part 2. This is part 2 of Walking with the Market. Go back and look at part 1. Write down the levels we talk about, the numbers. We spoke about it. We're coming up on key support levels. If we break it, what we can go down to. All right, so you see it. All right. If we break through this here 50% retracement level, right around 3,500, then you see those March 2020 highs. That big, thick red line there, it could be next. So I would not be surprised if we can't find support at some of those key support levels we talked about in part 1, because this is part 2. Some of those key support levels we talked about in part 1. If we can't find support, then we start breaking through those support levels and internal trend lines. Then the 50% retracement level is looking pretty realistic as the next area of interest. If we break that, see that big thick red line there? March 2020 highs? I hope we find support there. Because we start breaking below that, I don't know how low this thing can go. Okay? How low can we go? Nobody know. But I'm telling you, you might want to hold support there. Okay? Because it's some unfilled gaps that's sitting around just waiting for us to fill it when we start breaking them levels. And I don't know. We might go all the way back to the lows of March 2020. Who knows how low it can go? But I will tell you one thing. We're coming up on key support. And if we can't find support at it and bounce off of it, if we break it and then find resistance at it and fall apart and get a swing low, I don't know how far and how low it can go. And that's for real. So, look, we on the sidelines right now until this thing flush itself out. Okay? You got to flush yourself out. They might flush the taller stool on it. It just, boom, done. We'll see. Well, okay, now we're looking at the Nasdaq. This is a weekly chart of the Nasdaq Composite. Well, guess what? The Nasdaq Composite had broke below the 50% retracement level. It's coming down toward the 61.8, which is this gold line here. See this little gold line here? It might be hard to see. It's a little gold line here. This is the 50% retracement level right here. The Nasdaq has already broken below it. Okay? It has broken below it. That's key support. All the computer algorithm, everything is watching that level. Trust me on that. If you don't want to trust me, just keep watching and see how many times stocks hit these levels and start consolidating, bouncing. Matter of fact, don't trust me. Trust yourself. Trust your research. Look at what I'm saying to you and watch it for yourself. I keep telling y'all that even in our sessions on Mondays and Thursdays. Don't believe me. I could be a madman. Some people say I am. Okay? I could be completely out of my mind. crazy as I want to be. But maybe I'm crazy as a fox. Maybe I ain't as stupid and crazy as I act. Who knows? But this is not financial advice. But wouldn't it be wonderful if it was? Wouldn't it be great if it was? What if it was? Ching, 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 ching. But it's not. But if it was, ching, ching. Okay? For sure. You won't blow up your trading account. But right now, the Nasdaq Composite is back to the 61.8% retracement level. It's trying to get there to find support. It has broke below the 50% retracement level. From the March 2020 lows to the highs, we pull back and we done given back 50% of the move. You see why O'Neil said don't be trying to hold on to this stuff forever? Because if you ran up all the way up to the from the lows all the way up to the highs, and you still holding on to this thing, talking about, you know what I'm saying, you're a long-term investor, you done gave back 50% of your money. Come on. Let's be for real. You got to know when to sell and get out. All right? Well, we almost back to the 61.8% retracement level. All right? So we got to see what's going to happen now. Are we going to go down here and get to the break below the 61.8, and now we're into the golden pocket. Remember a few minutes ago I said the golden pocket, we'll talk about that, because I knew the Nasdaq was coming to it, all right? Here is the 61.8% level, retracement level. Here is the 76.4% retracement level. Inside the 61 and the 76 is what we call the golden pocket, okay? That's really strong support and resistance level depending on which direction the market is going in, or individual stock, index, ETF, whatever. Golden pocket, hard to break through that. Okay, and look what's right in the golden pocket. You see that big, thick red line? Look what's inside the golden pocket, in between 61.8 and 76.4. Look what's right inside the golden pocket for the Nasdaq Composite. You see that big, thick red line? That's the March 2020 highs. It's dead inside the golden pocket. So if we break in here and we break that March 2020 high, maybe we'll find consolidation inside the golden pocket and bounce. It's a very strong possibility. But if we break through that golden pocket, now I'm going to start telling y'all we might be going back to the March 2020 lows, way down here, and retrace the entire move all the way back. A complete round trip retrace of the entire thing. Okay? We are testing the golden pocket. If we break through that 61.8, we're going to be coming down, testing the highs of 2020 for the Nasdaq Composite. We'll be dead inside the golden pocket. We break below the lower end of the golden pocket. I'm looking for this thing to go back and take back the entire move. It'll go back to the lows of March 2020. All right? We're in the golden pocket because the computer algorithm is going to kick in then. They're going to flush the toilet on you. They're going to flush the toilet stool, okay? It's going to flush right out. All right? Now, here is the IWM on the weekly chart. All right? This is a weekly chart of IWM, and you see it. The IWM has now broken below the 50% retracement level, which is the crayon line, and the March 2020 highs, that thick red line. We have broken below both key support levels. If we rally back up and we find resistance there and it start breaking back down, swing low, and then it's going to start coming down to the golden pocket level. That's what I'll be looking at for the next area of interest. All right, we got to get back above this March 2020 highs, which is that, see that big thick red line there? The March 2020 highs and the 50% retracement level is the crayon line. That's the ticket right now for the IWM. But interest rates are rising. Inflation is kicking everybody in the behind. Gas prices are to the moon. People don't have money to spend like they used to. Who's going to suffer? Small companies, small business, small people, the little guy and girl. We the ones that are going to suffer the most. Okay? Not the big corporations. So what is the IWM? 2,000 small companies. 2,000 small companies. So maybe that's the reason why it has already broken through its March 2020 highs. heading down to the 61.8% retracement level if it can't get back above that. And then we're going to be falling into the golden pocket between 61.8 and 76.4% retracement level. Right now, from the March 2020 lows to the highs of November last year, it already took back 50% of the move. We start getting below this gold line here, start trading back down into the golden pocket. We break below the lower end of the golden pocket. I already told you. They would have to show me and convince me. I'll be from the show me state at that point. I'm from the show me state that you're not going to go back to the lows and take back the whole doggone thing, complete round trip. It's possible. When fear set in, people get hysterical. Fear instead of pandemonium. Fear. Blood all over the streets. This thing could go back to it could just make a complete round trip. The golden pocket better hold it. That's the IWM. Now, let's look at the market breadth. Look, this thing is bad. Okay? There's no ifs, ands, or buts about it. This thing is bad. This is the total U.S. market right here. If you can't get above the 50-day moving average, well, what is it to talk about? You already know that the market is down. Okay? Trading below a 50-day moving average, trading below the 200-day moving average is a problem. This is the percentage of stock in the Standard & Poor's in the total U.S. market. This is the percentage of stock in the total U.S. market that's above its 50-day moving average. You can't get above the 50-day moving average, then what is it then? It's trading down. You saw that 50-day moving average act as resistance as prices was consolidating, fell out the consolidation channel, and boom, boom, ching, ching, we took it to the short side. You seen that, okay? So right now, the percentage of stocks in the total U.S. market above its 50-day moving average is only 12.9%, 13%. Only 13% of the whole U.S. market is above its 50-day moving average, y'all. Stocks are not trading up. They are trading down. It's a problem. All right? We past problem now. We at my mentor's word, problem. We got a problem, okay? Now, look at the total U.S. market percentage stocks above its 200-day moving average. Only 11%. We talking about over 10,000 stocks, y'all. Only 11%. 10% is 1,000 stocks out of 10,000. Only 11% is above its 200-day moving average. Man, we are at, listen, I'm going to minimize this thing so hopefully you can see it. We are at extremes. Okay? You see, we at the lowest levels right now that we've been on in the last, I just took this back 10 years. Okay, you're looking at 10 years right now. We at the lowest level right now. It's only been lower than that twice. Okay, it's only been lower than that twice than what we at right now in the last 10 years. You see how the thing is selling off? Okay, we had this low back in 2018 and we had a low back in 2020, the corona collapse. Those are the only two times in the last 10 years we've been lower than where we at right now. 11% of the total U.S. market above its 200-day moving average. Look, 1 or 2 days of up move. Don't be getting fearful that you're going to miss out on something. Don't catch no FOMO. What you missing out on? Only 11% of the market, total U.S. market, is above its 200-day moving average. So if this thing going to get any rally, any legs to the rally and go back to the highs, the inverted yield curve date, go back to 200-day moving average, whatever, you got a whole almost 90% of the market left to go. What are you worried about? Come on, don't let nobody. Don't let these people. Don't get caught in the hype and hysteria on the news. Don't go for it. We're looking at the data. It's right here in front of us. This is the Standard & Poor's 500. Percentage of stocks in the Standard & Poor's 500 above its 50-day moving average. Only one. 1.9%. Only 2%. Okay, I rounded up for you, 2%. Only 2% of the Standard & Poor's 500. Out of 500 stocks, only 2% of them is above the 50-day moving average, man. This is crazy. You don't worry about 1 or 2 days of up move. Forget that. This thing is no participation. Most of the stocks are in the doghouse. They done got taken out to the woodshed and got whipped. Boop. Got their behind beat. Took them out there behind the woodshed. Gave them a beat down. Okay? You already see that. Look at the percentage stocks in the Standard & Poor's 500 above their 200-day moving average. 10%. I don't have to do the math for you. You know what 10% of 500 is? 50. Only 50 stocks in the whole Standard & Poor's 500 is above their 200-day moving average. What rally? Right now, we have to wait until the rally happens. Be careful. We're looking for clues because we at extremes. We haven't been this low in a long time. Look. Let's see if we can minimize this thing. Okay, let's see if we can minimize it. And well, it done got a little corrupted there. I can't seem to minimize. Apologize. But anyway, you get the picture. We are at extremes. We haven't been this low maybe once or twice, maybe 2 times, like I just showed you, and maybe 3 times in the last 10 years. Point blank period. Now for the Nasdaq, only 17% of the Nasdaq is above its 50-day moving average. That's this chart right here. Only 17% of the Nasdaq is above its 50-day moving average. Okay, 17% out of 3,000 stocks, y'all, is above its 50-day moving average. And look at the 200-day moving average. Percent of the stocks in the Nasdaq above its 200-day moving average. Okay, right now it's only 12%. Are you digging what I'm throwing down? Are you following what I'm saying to you? Holla at your boy. Okay, you got what I'm saying to you? This thing got no breath. There's no participation. Most stocks are falling apart. There's no reason to fear. If we get 2 or 3 days of 1 or 2 days of an up move, whatever, we're looking for a follow-through day. 1 or 2 days is nothing. The follow-through day is what counts. And then, look, let's go to our go-to chart. The creme a la creme, the granddaddy of them all. The Dow Jones Advanced Decline Issue Differential Invisible Chart. Our creation that is right the majority of the time. You see that green arrow, that's when things are great. That's the go, go, go. We had our follow through right after that. But right now you see the green line is below the 0 line. It's below the yellow line, which is the 21-day moving average. It's below the 50-day moving average, which is the red line. And all of them are below 0. This is the Dow Jones Industrial Average, invisible chart, advanced decline of issues, the differential. Everything is down. When the green line is below the yellow and the red and below 0, that's not the time to be trying to go long. Well, it's telling us to stay in cash. We need that green line to get above the yellow and the red and get back above this horizontal red line, which is the 0 line, and then we'll generate our green arrow. So the Dow Jones Industrial Average is telling you, be careful, okay? Here, the same chart, advanced decline differential invisible chart. The green moving average, the green line, which is the green moving average, look how low it is. It's well below the yellow and the red, and everybody is below the red horizontal 0 line. Everything is below the 0 line. We need to see the green line cross above the yellow and the red and get above 0. Then we get that green arrow, and then we need the yellow and the red to start trending up and get above 0 also. Right now, it's a no-go. It's telling us to stay more in cash. You see, we're not going to get hurt. If this is not financial advice, but if it was, ching ching, but for sure, you won't blow up your trading account. Pay attention. Don't believe me. I could be a madman. Follow what I'm saying, and then let me know what you think. This is the Nasdaq Composite Advanced Decline Differential Chart. The green line, the green moving averages. We got the red. We got the green line is the 9-day moving average. I'm sorry, green is the green moving average. What the word I'm talking about? The green line is the 9-day moving average. The red is the 50, and the yellow is the 21 of the data that's in the background that's invisible. This is the Nasdaq one, right? Well, the green is below the red and the yellow, and everybody is below 0. Nothing to talk about. Sit on the sideline, wait for a proper setup. We in cash. When it goes, when we get our green arrow, we'll dash and run, and then we'll slow up, go in slow, and build up momentum, build a position, we'll hurry up to slow down, as they used to tell me back in the day. Hurry up, Brown, and slow down. So I will run to the computer, slow down, go in slow, build a position when the time is right. But we got to wait for this green line to get above the yellow and the red and for them to get above the 0 line. And we be looking for that follow through day, looking for that volume coming in, breaking above those key support levels, key long-term moving averages. And then it's a go, go, go. Ching, ching. Well, look, this is part 2 of walking with the market, staying in step with the market, staying in tune with the market, so we can be right almost on almost everything that we do. If we get the market direction right, y'all, 3 out of 4 stocks are going to follow the major market indexes. 75% of the stocks are going to follow the major market indexes. So why fight that? It just doesn't make sense. See you in the next video.